Alrighty. So last class, we went to Finance Yahoo, we downloaded data, and then we calculated daily numbers, returns, in a couple different ways. One was using final minus initial over the initial, and the other one using the rate equation in Excel. And I think the last thing we did, we calculated the average of the monthly daily returns. Is that where we stopped? Okay, so can you tell me where did I calculate that, what cell, so I can use the same one? What is the average? Okay, so if not, I'll do it here. Is that the number we obtained last class, 0.23 or close? Okay. All right. So that will be the daily average. You can insert columns, call this one the mean. So what are the functions we can calculate in Excel when we're doing analysis of stock returns in this case? So we have the average. Another one can be for volatility. What can we use? The standard deviation. Okay? And to do that, the command in Excel is stdev, standard deviation. You open the parentheses, and then you highlight again the entire column. So it is 3.61%, the standard deviation. Recall that you have to practice how to select data quickly. You saw that I did this very, very quickly, so I'm going to give you a couple seconds to catch up. Okay? How was that? It will be equals stdev. That's the command for the standard deviation. Open the parentheses, and then I'm using column H, and even though H and I are the same numbers, different ways of calculating the same thing, but you click on that will be H3, and then you do what to select the entire thing? Shift, and you hold it, and then End, just one click, and then down, and it selects the entire column, and then you can close the parentheses, and it'll calculate for you the standard deviation. And then I format that with 2 decimals and percentage. Okay. What else can you calculate in terms of statistics when you're doing analysis of? Can be anything. What else will you be interested in? About the median. And what is the difference between the median and the mean? Median is what? Is the point in the middle. So if you sort all your numbers from smallest to largest, the point in the middle will be the median. Okay? And the command in Excel, can you guess which one is it? That one is easy, median. Okay. So again, you open the parentheses, you click on the 0.61, and then shift and down, close the parentheses, and it will be 0.02%. And in this case, there's a big difference between the mean, 0.23%, and the median, 0.02%. Now, the mean and the median are what? Central tendency. They tell you more or less where the middle lies, where the median is exactly in the middle. Which one is better, to use the mean or the median? Which one is more appropriate for central tendency? So sometimes it depends on the circumstance. Okay? But let's say you're applying for a job. Will you ask what is the average salary in the company or the median salary in the company? One may be, so if you ask for the average and they include everyone in the company, that number might be skewed. Why? Because you have the CEO in the sample, and she makes, let's say, $7 million per year. The average income salary is going to be very, very large, but it doesn't mean you'll be making that much money. So the median will tell you the point in the middle, which will be more reflective of what you can expect to make in that company. So just something to ponder. Other things we can calculate, and we'll be using all of them at some point. The maximum number. So what is the daily max return in your sample? The command in Excel is max. And then you can do the minimum, which is MIN. So I'm going to select that. So there's a 42% jump in Netflix. There was one day in which the stock jumped 42%, single day. We can find it. Okay. And what will be the minimum? Equals MIN. Open the parentheses. So there's one day in which the stock lost almost 35%. The point of using Excel, look at the possibility. You can do analysis on a real company, real stock, decent recent data, and you can do this on the fly, all this analysis. So what will be the range for the stock? Now, there's no range command in Excel, but how do you find the range? It will be the max minus the minimum. So it will be 77%. What is the range used for? When you do analysis, statistical analysis, what is the range used for? It tells you what about this? Because the mean and the median are central tendency. So what points are in the middle? Average. Max, minimum, and range, they give you what? What will you be assessing about the stock or any number? So the spread, and the spread, which is the range, it calculates what? It's volatility. Okay? Because if you have a stock that has no volatility on a daily basis, the range is going to be very small. And your max and minimum are going to be very close to each other. But this is one stock that has volatility because the max and the minimum, there are 77 points in between. So it can be anything in between. And then we'll do the graph so you can see that volatility. But if you don't have the graph, the range, the max, the minimum can help you with volatility. Okay? Again, remember that something you can do, if you click here and you click on review, you can take notes, but you can new comment. So the range is range indicates volatility. Okay? And then you can click somewhere else. But anytime you roll over that cell, it'll put that comment so you can remember. So what am I doing with the range? It's volatility. Okay? Now there are, yes. It's recording right now, so when I finish the class, I'll upload it. Okay? Mm-hmm. Now there are others. You may not use these ones very frequently, but you can calculate the skewness in your data. And once we plot the data, you can see that it's a skew maybe left or right. And the command in Excel for skewness is skew. And there's a couple of them. Depends on the Excel you have. But you see that one says skew and skew.p. P is for population. That is if you have the entire population of numbers. This is a sample, so I'm going to use just skew. It doesn't change very much, the number, but it's more appropriate to use the sample. And so again, open the parentheses. We click here. Select that. So this is skew 0.95. Are you familiar with the concept, skewness? You should have calculated that at some point. Yes. Mm-hmm. For a stock. So your numbers are not exactly those. They're close, but not exactly the same. Maybe make sure you have this formula correct. That will be final minus initial over the initial. You have that. What is the? Do you go from here's 1/17/2017? Is that the latest date you have? If it's not, maybe when you downloaded the data, you selected a different range than I selected. But if the numbers are close, as far as calculations, you're fine. And the earliest date is 1/19/2010. Is that what you have at the bottom? Okay. 0.95. I'm going to switch to the projector. And instead of using the whiteboard, I'll be using this, so it's also recorded when you watch the class again. So we can see what that number exactly means, excuseness. What is that called, that graph? It's a normal distribution. Okay? It's a bell-shaped distribution. And what is a statistical distribution? Why is it called distribution? It includes every possible outcome data in your data set. All of them can be found in that distribution. Okay? Why is it called normal in this case? Because most of the data in life exhibits that behavior. Okay? You have a few extremes on the right, a few on the left, and then most of the points are going to be located in the middle. Okay? Think about age. Okay? Some of you are very young, and you will be on this side of the distribution. And then I'm going to be right here on the right side of the distribution. Most of you are going to be, I'm guessing, 21, 22, 23, 24. So you're going to be right here in the middle. And we can go to every classroom, and it's going to be the same behavior. Heights, the same thing. Some of you are very tall, some of us not so tall, and then everyone else somewhere in the middle. Okay? Stock prices, stock returns, they follow the same pattern. They're normally distributed. You have sometimes the stock making a lot of money in one day. You saw that, 42%? Some days it lost 34%. Most of the time it's going to be around the average, which is 0.23%. Now, how do you know if it's normally distributed? Well, a normal distribution, when it's perfect, it's symmetrical. You have the same number of data points on the left than on the right. But sometimes it may look like this. Where you have more points on the left and you have more points on the right in the second case. So it's not perfectly symmetrical. Okay? And the way we calculate that is with skewness. The data is skewed in this case, which way? To the left, and this one is skewed to the right. Now, what is the skewness of a normal distribution? What is the value? 0. If it's skew equals 0, it's perfectly symmetrical. This one is 0.95, so it's not perfectly symmetrical. And when we draw the picture, we'll see that it's not perfectly symmetrical. Okay? And in life, that is the case. Data is not perfectly symmetrical. It approaches symmetry, but it's not always perfectly symmetrical. Okay? So in this case, we have 0.95, and this is what sometimes I get confused, which means that it's skewed to the skewness can be negative and it can be positive. In this case, it's 0.95 positive. So it's slightly skewed to the, if it's positive, to the right, which means this one, right? I think so. Once we draw the picture, we'll figure it out. Okay. So that is skewness, and we can do that in Excel. Okay. Let me go back to the computer. When I do one more calculation, there's something called kurtosis. Okay. Does anybody know what that is? Kurtosis? Let's do the calculation, and then we'll explain it. And the command in Excel is KURT. Okay. And so I'm going to select the data again. And kurtosis in this case is 22. Just to be consistent. That's fine. Let me go to the notepad. Kurtosis means the following. For a normal distribution, kurtosis equals 3. Okay. Now, it can be symmetrical with skewness 0 and kurtosis 3. It means it's perfectly normal. But sometimes kurtosis can be greater than 3. It can be less than 3. And when it's greater than 3, it looks this way. You know, they're kind of all lumped together in the middle. So you see this kind of tight distribution. It's not, doesn't look like a bell. And then you have the other case when it's less than 3, in which it looks like this. No, it's the other way. When it's tight, it's less than 3. Sorry. When it's, yeah, this one is less than 3. And this one is greater than 3. So you can have that bell shape. It's just that in one case it's very tight and the other one is very spread. In this one, the kurtosis is 22, so there's a lot of stretch in the bell distribution. And you can see that in the range. The range is 77 points, so there's a lot of volatility in the stock returns. And those are things that I will be asking in the exam. You know, what is skewness? What is kurtosis? You have to do the calculation. Okay. So if I were to ask you, is the distribution of the stock returns for Netflix normally distributed? And it will be no. Kurtosis is 22. Skewness is 0.95. Now, when we draw the picture, it may approximate normal distribution, but it's not perfectly normal. And that's how you know. You do those calculations, all right? So those are different statistics you can calculate in Excel. Now, I'm going to show you a different way to do the same thing in one step, and it does, I think, more calculations. The difference is that if you change a number here, because these are formulas, they're going to change as well. The other way in which you can do statistics, once you calculate the numbers, they're going to be fixed. So if you change something, then you have to rerun these commands. And you do it in this way. Go to data up here. And you can add options right here. And they're not present. They tend not to be present. So we're going to do the following. Go to File. Go to Options. And then you go to before the last one. They're called add-ins. So you can add menus and commands to Excel. And they're here at the bottom. So the default is Excel add-ins. So you can click Go. And there are 4 here available to us. So we're going to be using Analysis Tool Pack. So check that box. In my case, it's the top box, and yours may be a different one. And then click OK. And when you do that, you're going to see a new menu, a new option. It's going to pop right there. It's called Data Analysis. So we're going to click on that one. And these are all the different options. And we'll be using, there's one called Descriptive Statistics. So click on that one. And then you click OK. And then here it says Input Range. You're going to select the same numbers we've been selecting in column H. So we click here. And then select your data in the same way. Shift and down, and then you press Enter. And I'm going to stop for a few seconds to give it a chance to catch up. Is everyone here in this pop-up window? Yes. So we added the Analysis Tool Pack, and then we went to Data Analysis up here, selected Descriptive Statistics, and then we selected the Input Range. And then options here, your data is grouped by columns. You can have it by rows. In this case, it's one column. You have no label. Sometimes you can, like up here, you know, we have adjusted close. But in this column, I don't have a label. If you select your column, including the label, just click that option so Excel can ignore that from the calculations. Now, where do you want the output? You can create a new worksheet, which are these ones right here. I like to have it in the same place, so I'm going to click here, output range, and then you click here, and then you select the place where you want this to be populated. I'm going to select this one, N1. So output range, N1, and then you want this right here. You check that box so you can get your summary statistics, and then you click OK. So there's the mean that we calculated before using the Excel command. If we format this with percent and a couple decimals, you can see we get the same number. Here's the standard deviation, median, the mode. What is the mode? I didn't do that one. Not popular, but repeated. And in Excel, the command is this one. So, equals mode. Okay? And then you can select your data. I'll do it here. Mode. And the mode is 0 because there's no one number that repeats itself several times. Okay. So which way is better? If your data doesn't change, like in this case, then you can use the Excel command. It's very quick. It gives you all of them instead of doing one by one. But let me show you. I'm going to change that number to, I'm going to use a big number so we can see the change, 50,000. Okay. Look at all these numbers. They automatically change. And look at the table. It's the same mean we had before. So that's a disadvantage of that one, that it doesn't update when you change a number. So which one is better? It just depends on what you're doing. Okay. But both will give you, the first time, if you don't change anything, the same numbers. Okay. This one right here, count. Let me show you how to use that one too, because we'll use that one several times throughout the semester. That's how many points you have in your data sample. So in this case, we have 1,761, and I'll kind of call count, and the Excel command is count. So then you can select that. And we get the same number. Questions so far? Okay. So let's do the following. Excel has some visual aids. I'm going to click on H and 2, and I want you guys to select the entire column, as we did before. And then you will go to your Home menu tab here, and then click on Conditional Formatting. And then if you click on Data Bars, there are several color palettes you can choose. I'm going to select the second one, the green. And what it does is, it's like a bar chart. So in every case, look at all the negative returns we have. You see a red one. And every time you have a positive one, it's a green bar. And then the size of the bar tells you the magnitude of the change. So it's a nice way to visually see which ones are negative, which ones are positive. And then when they're negative or positive, how big is that number, the magnitude. And that's just for visual aid. It might help in a presentation. And then if you see one like this, there's a green bar in there. It's just that it's so small that you can't see it because it's almost 0. And then some of them are a little bigger. You know, these red ones, greens. So using that, what do you think about investing money in Netflix? On a daily basis, do you make money or do you lose money? You know, there's a losing streak right here. There's here that 34%. There's some green ones here, looks better, greens. But what would you say? More days you lose money, more days you make money? What do you think? Can we count them? How many data points do we have? 1,761. How many of those are positive? There's a way to do that in Excel. Okay, so I'm gonna do this. I'm going to count how many of those returns are greater than 0, meaning how many of them are positive, right? And right here, the command in Excel is the following. Count if. So we can count if a condition is met. Okay? And then we open the parentheses, and then Excel is asking you for a couple of arguments. The range and the criteria. The range will be which one? You're selecting your entire data. So let's do that again. I'm going to select all of it. Okay. And then you have to follow that by a comma, right? Because it says right here, count if, select the range, and then you put a comma, and then we can select the criteria. So I'm going to type a comma. And if you can't see the equation, that's because it's at the very top. So okay. That's what I have so far. And then the way you input the criteria, and this is important, you have to use quotation marks. So you put those quotes, double quote. And then what is the condition in this case? It will be greater than 0. You close your quotes, close the parentheses, and then it will tell you how many of those are exactly greater than 0. So it's 882. So what proportion of the days in the sample is the daily return positive? If I do the following, you know, I have how many are positive, and you divide that by the total, right? That will give me 50% basically in this one. Let me turn that into a percent, maybe add a couple decimals. So 50% of the time, on a daily basis, you will make money, or you made money in this stock. Okay? I don't know. Let me center this one. Let's call this one I don't know, percent positive. So how many are negative? How will you do the negative case? Try on your own doing this ones. And then I'll do it with you. Count how many are negative, and then what proportion of the daily returns are negative. Okay. Now, if you're thinking, well, to find the negative ones, I'll just do total minus positive ones. Sometimes the daily return can be exactly equal to 0 because the stock opens and closes with the same number. So it doesn't happen very often, but it may be the case. So it's better to count how many negatives you have instead of you doing one minus the other one. So how do we do the negative ones? How many? Equals what? Count if, and then you select the entire. Now here I want to give you a little trick, because there are different ways in which you can do this. If you see in my H column, in my case, and it may work if you have a label, but I don't have labels, and I don't have any other numbers after my last data point. So a quick way to select also data, I can do the following. H, semicolon, H column, H. And that's going to select the entire H column, so you don't have to be selecting with the keyboard. That only works if you only have numbers you need in the calculation. Okay, so that I do comma, and then it's asking me for the criteria. So it will be quote less than 0, close the quote, close the parentheses. So it's 875. Let me do this for you. So those are the formulas that I'm using. Right? And you can use any way to do that. And the proportion will be which one? Will be equal to the number of negative ones over the total. So it is 49.69%. That's how many times on a daily basis is negative. So you break even. Okay. So do you make money when you invest in Netflix? Half the time you make money, half the time you lose money. Do you make money or not? You do, because the daily average is what? 0.23%. So in the long run, you do make money, because even though you lose money and make money 50-50, very close to that, on average, when you make money, you're making more money than on the days you lose money. So in the long run, if you invest in this stock, so far, you do make money. Okay. Are there any numbers equal to 0? Has anybody done the calculation? How about this one? Equals 0. And if you see, if I put equals 0, it won't put the equal sign because it's equal to 0, that cell. So the way you can do that, if you put a single quote mark like that, you can do equal 0, and then it's going to treat that as a text instead of being a numerical formula. So for that one to work, to have the equal sign, you have to begin with that single quote mark, and then it will do that. Count if H, colon, H, comma, open quotes. What is the condition? Equals 0. And there are actually 4 days in which the stock yield 0. So it actually happened. And what proportion equals that over total? 0.23% of the time, the stock yields 0. And remember that this will be in the exam. You will have to open Finance Yahoo, download the stock, set it all up, and do all of these calculations. And I will not be giving you homework. I do give you homework, but it's a model. But the best thing you can do is tonight download a new stock, a new company, and go back and redo all these calculations on your own so you can get practice. And you can do it very, very quickly. Okay? So we have all of those numbers. Now, I want to ask you the following. We know that the stock loses money and makes money 50-50. And overall, what is the average? Daily is 0.23%. So what would be the average on the days in which the stock yields positive returns? And what is the average on the days in which the stock yields negative returns? There's another command in Excel, and it's called the following. Average if. So you're going to do the following. Select the range, so you can calculate the average in that range, but only when the returns are positive. So we do H, colon, H, comma, and it works the same way. You open the quotation marks, put the criterion, greater than 0, close quotes, close parentheses, So what is your daily positive return? It will be 2.47%. And what is the daily negative return? It will be negative 2.03%. So I'm going to call this one, even though it doesn't fit in my column, but let's call this one daily positive return. And this one will be daily negative. So see, even though 50% of the time you lose and make money, when you make money, on average is 2.47%. And when you lose, on average is 2%. So that's why, in the long run, you will make money in this stock. If you like investments, if you look at do analysis on a stock, if you're thinking about buying a stock, this is some of the analysis that you can do just to gain some sense of how the stock behaves over time. Okay. And when you do the statistics, you can see volatility, you can see central tendency, you can associate this with a normal distribution. Questions so far? No? Okay. Let's do some graphs. We're going to be plotting three things: the close price, the adjusted close price, and then we'll also plot the daily returns, so you can see the behavior in all of those three. Okay. When you do stock prices, stock returns, there's a couple of useful graphs you can use in Excel. And to do that, you go Insert. And here are all the different graphs you have. And we'll be using many of them. But today, we're going to discuss the following. There's line charts. And then you have this one right here, which is called scatter plots. And they both look the same. Really, look, this is a line. This one is a line, but it puts a dot, whatever you have a data point. And the other one, the line, this line, right here. So that's line, line with a data point. See, they look the same. But what is the difference between line plots and chart plots? Does anybody know? They look the same. Sometimes they can look different. But what is the main difference between a line plot and a chart plot? Let's say you have the following data to plot. So we have X and Y. And we have here 5, 10, 20, and I'm going to use here 50. So that's my X. And my Y, I'm going to use easy numbers. Actually, I'll use the same number, so it's a straight line. So you want to put that in a graph. In a line plot, a line chart, we have the X, and we have the Y. And in every case, Y equals 10. So if you do an X, a line plot is going to look like this: 5, 10, 20, and 50. And that will be your line plot. Now, look at the distance between 5 and 10, 10 and 20, and 20 and 50. It's always the same. Okay? And sometimes it's okay. If you have categories in the horizontal axis, you can use that type of line. But if you want to keep the scale in an XY graph, it's going to look like this. So we have Y, we have X, and we have 10 for the y, and then we have 5, and then 10 here, and then 20 here, and I'm going to run out of space because 50 doesn't fit in the line. But what is the xy doing here? It is keeping the proportion in the horizontal axis. So this is 5, so twice as much of that will be 10, and then twice as much will be 20. So it will keep the scale for you. When you're doing a stocks analysis, investment analysis, financial analysis, always use scatter plots. Do not use line plots. Okay? It is important to keep track of the horizontal distance, the scale. Both line and scatter will keep the scale proportional here in the y-axis. But the line plots, it looks at the 5, 10, 20, and 50 as labels. And the scatter plot, it looks at the 5, 10, 20, and 50 as numbers. So, it draws them proportionally and puts the right distance. So let me go back to the computer and zoom out. Now, for the graph, date will be the horizontal axis, and then the close price is going to be my vertical axis. And then we'll do the same for adjusted close, and then we'll do stock returns. So if you click on one of those cells and you go to the line options Excel has, Excel will try to guess what are you trying to plot. Okay, so to avoid that, and sometimes it does a good job in guessing. So once you get used to using lines, you can do that. But I'm going to click over here, way out there where I don't have any data, so that when I click in Insert Graph, it doesn't try to guess what I'm trying to plot. And let's do the following. So I'm going to do Insert, and then Scatter Plots. And you have several options. This one, it puts a point, wherever you have a data point, but it doesn't connect those points with a line. And sometimes that's useful. We'll use that when we calculate betas. And then that one, it does connect the points, same as this one. But here it tries to smooth the line, and this one, it uses right angles. So let's use this one right here. I don't need the data point. I have way too many of them. Select that one, and it's going to put the graph right there. And it's empty, so we have to populate it with data. And the way you do that, you should see this menu in your Excel. If it's not right there, then you have to click on the graph. And then there are a couple of menus for charts, the design and the format. Format is just if you wanted blue and red and different colors. Design is where you can add data. And then you have this option here, select data. So click on that one. Okay. And then we're going to add a new series. So you click the add command here, or the add option. And it's asking you for a name. And you have a couple options here. You can click here and select the label. So it's called close, or you can type it. I'll just click here, click there. So it's close. And that's nice because if you change the name of the label, it will automatically change also the name right here. And then what is my X? X we said is going to be dates. So I'm going to click on date right there. And then use the same trick. Shift, hold it, click, end, and then down. And press enter. So I have my X data selected. And now what is my Y values? They're going to be the close. So I'm going to click on that one, shift and down, enter. I can zoom in on that pop-up window, so something you have to. And let me give you guys a chance to catch up. If you fall behind, if you want me to repeat the step, let me know. Okay? For now, it's okay to go back and repeat this several times. Eventually, I expect you guys to be able to do graphs quickly. Do I have to repeat it for anyone? No? Okay. Let me click OK. Click OK. And it's going to be up here. We're out of the way. So that's the closing price. What happened to the stock right here? How come there's a huge drop in the stock price right there? There's one here too, but it's a little jagged, okay? So there's volatility in that one. This is just a straight down drop in the price. What happened on that day? When they split the stock. If you remember, we saw last class that there's one day in which the stock fell by 7 times because they split the stock 7 for 1. That's why you never use the closing price for doing stock price analysis. You present that to somebody, and you don't know that they're using the regular closing price, and they think this is not a good investment. You know, it just fell, it just collapsed. But that's not the case. Okay. This right here, see that big drop? That's a real drop. And I remember that's one day in which Netflix increased prices, and people didn't like it, and the market assumed people will leave Netflix, find another service. So people abandoned the stock, and you saw that big drop. They're sorry they did that because then it came back with a vengeance. So now do the following. Let's add on top of this one the adjusted closing price. And to do that, you click on your graph, you click on design, select data, and then add a new one here. And you have to do the same thing. Click a name for the adjusted closing price, click on the X values, click on the Y values, and then click OK. So I'm going to give you guys a couple minutes to do that. Okay, so you click on your graph, so you can see this menu right here, and then you click select data, and then here you're going to add a new one. So this closes the one we just did. So you click add, so it's going to give you the option to add one more on the same graph. Okay. So the name is just a close. X is going to be date, and Y is going to be adjusted close. And you should see something like that. Okay. And in this one, you don't see the big drop because the stock has been adjusted for the split. And not only they adjust the prices after the split, they also go back and adjust any stock price before the split, so you can have a nice continuous line. Now, if you see a big drop, it is because the stock price fell on that day. It's not due to a stock split. Okay. And do you guys have a legend in your graph, so it looks like mine? Because sometimes Excel automatically adds a legend. I was hoping. If you click Format, it's right here in Design, you can select one of these ones, Quick Layouts. And you can go through all of them, and you can choose the one you like better. So in that case, you can have a title. So this can be what would be a good title for this one? Netflix daily stock price. And I forget that range. It would be nice to have also the date range. Okay. And then we have the close and the adjusted close. What is the axis title for the X? It will be date. The vertical will be stock price. The units are dollars. Okay. What is one problem in interpreting this graph right here? What is one potential problem you see? Which one looks more volatile? The regular closing price or the adjusted closing price? The regular one. And why is that the case? Why does the adjusted closing price looks less volatile? Because they should look equally volatile because it's the same stock price. It's just a split, 7 for 1. But we didn't change the volatility, just the price scale. So why does this one look so not volatile? Look at the stock price. It goes all the way to 700. But what is the maximum stock price when you use the adjusted closing price? It's about 120, 130. So that line it's compressed because of the scale, and that's why it looks less volatile. So those two should not be on the same graph. That's one option. Or they should not be on the same scale. So Excel is going to give you the following option. We can move one of the two lines to a new axis, and that new axis can have its own scale. So let's move the adjusted closing price, and you do that by click on the orange line, which is the adjusted closing price, and then see this option right here, primary axis, put in the secondary. So now you can see that they mimic each other very, very well because it is the same stock. The only difference is you don't see that big drop because that big drop doesn't really exist. It didn't happen. It's just because of the split. This right here, you just click on the double click, right click on the line. The only personal preference I have when I'm doing graphs, I don't like to have the legend on the right side because it compresses everything horizontally. So I like to have this one at the bottom. I mean, and that's just a personal preference. Okay, questions? Okay. So in the exam, I may give you a stock that went through a split, so you can do both for me, and you have to split the two graphs, secondary, primary axis. Doesn't really matter which one is in the left and the right, as long as they are separate, okay? I mean, bless you. Now, do one more graph, but now you're gonna do horizontal axis, scatter plot, date in the horizontal axis. So you're going to plot that daily returns. Instead of plotting the stock price, plot the daily return and see what that looks like. No, a new one. And the reason for that is because the scale, they're very different. One is percent, the daily returns is percent, and this one is stock prices. And you only have two axes. So if you plot the daily return in this one, it's 0.1, 0.01. So it's going to be completely collapsed at the bottom. So in a new graph, plot the daily returns. You can use column H or you can use column I. Doesn't matter. I'll do it right here. will see something like that in your Excels. Do you have the graph on your screens? How are these two graphs different? I mean, what do you learn about these two graphs? Why have both of them in your analysis? Can you see the volatility in both stocks? I mean, both it's the same stock, but they both give you a sense of volatility. You know, this one, the regular stock price, you can see that jagged line. That means volatility because the stock price goes up and down, and it's daily. Okay? And then you can see over time that the stock goes up, and then it goes down, goes up, goes down. And ignore this big drop. Let's concentrate on the adjusted closing price. Okay, so you do see the volatility. You see tendencies in the stock price. What is the overall tendency of the stock price for Netflix? It's upward trending. I mean, it's volatile, and it goes up and down, but you see that upward trend. And we'll be doing trend analysis later. We can add trend lines. How about this one? How is this one different from that one? This one calculates the daily return. And you can see those big days in which the stock pops in one day. How much? 40%. And then it drops 35% right here. And then you can see a lot of those. So you can see a lot of volatility in the stock. This jump right here, which is the last one, the latest one, Netflix released earnings a few days ago. And they came out better than expected. So there was a big jump on that day. And then it goes back to normal behavior. Now, what is the daily average return for Netflix? Is 0.23. So if I were to draw that line right here, it would be where? Somewhere here. And it would be a straight line because that's the average. Okay, and it's 0.23. And what behavior do you see in the daily return? You know, when compared to the mean? Let me go to the... So we start plotting in Excel this, it looks this way. You know, some drops, it pops. Sometimes you see more volatility and then it slows down. But you see that up and down behavior and the mean goes through right up to the middle. Okay, so that in statistics, with econometrics, has a name. Does anybody know? Have you taken econometrics? No? Maybe you have, but you don't want to tell me. It is called mean reversion. So when you have stock price returns, corporate profit returns, they have that tendency. They tend to go back to the mean. Eventually, it goes back to the mean. Because I have daily returns here, you can see that it goes back to the mean, you know, almost daily. And sometimes it goes off and it goes down and it goes up and down. But you see that tendency to go back to the mean. Let me go back to the computer. That is called mean reversion. So we have a couple of we have a few columns here in our data set, and we have the stock price right here, adjusted the price, and it's good to have that. You need it for the analysis. But when people forecast the stock prices, they do not forecast the stock price, they forecast the return, and then from there you can forecast, you go back and calculate the stock price. So you may forecast Netflix will go up 20% this year. That is your forecast. And if you know the stock price today, and you're forecasting 20%, then you can figure out what the price will be 1 year from today. But people don't forecast the stock price directly. Why not? And again, you have to take econometrics for this. But when something is mean reverting, it goes back to the mean that way. We call that it's a stable time series. And because it is stable, we can forecast it into the future. If they behave like this, that they go up, there's a trend line in that, and then the forecast will not be stable, and you're going to make a lot of mistakes in your forecast. So that's why we have both calculations here, the daily return, and then we also have the stock price per se. I will not be asking you guys to forecast, not at this point. Just know that the stock price per se, the graph is not stable over time. It has tendencies, it has trends, and if you want to forecast, you need to have a stable line without any tendency or any trend lines, and that's why we do the daily returns. Okay. Plus, they give you volatility, and it shows all of that. Okay. Any questions so far? Again, trust me in this one. Practice, practice, go home and do all of this again so you can do it in the exam. Okay. I'm going to do one more thing. We're going to draw the distribution for the returns. And for that, we need a histogram. So, this one. I'm keeping this sort of small, very difficult to see, but I need to have all the space on the screen. What is a histogram? I know you have taken statistics. Yeah, and what does it show? When you draw a histogram, what do you get? It has bars, and what do they represent? Each one of those bars represents what? Categories. Okay. And then you can plot your histogram, and you can see whether your distribution is normal, uniform, bimodal, etc. So this is how you do histograms in Excel. You need to make your own categories first. Okay? So we're going to do those in the following way. I'm going to do equals right here. And the category, the first category, it's always the minimum in your data set. We already have the minimum. So I'm going to click here, equals, and then go up and select right here, minimum. You can select this one, or you can select the other one we did with the Excel commands. It doesn't matter. They're both the minimum. Okay? So that's going to be the bottom of your first category. Okay? And then I want to have 20. You can have 10, you can have 15, 20. The more you have, the more detailed, the more precise the histogram is going to be. When you do this by hand, it takes a long time to do 20, so you may do 5 categories. But so here we can do many of them. Did you build histograms when you took statistics or not? Maybe you did. Did you do it by hand or you use a computer? By hand. And so how do you do that by hand? Once you have your categories, you go through your whole data set and you count, okay, this one falls in this category, and the next one falls in this one, and the next one falls in this one, and then you count how many you have, and then you can make a plot. When you have 10, 20 observations, that's doable, but when you have 1,000, almost 2,000 of them, you have to use a computer. Okay? So we're going to do the following. The next category is going to be the following. It is going to be equal to the previous category, okay, plus, because I want all the categories to be equal, I'm going to divide the range into 20 spaces. So we're going to do the following. Plus, click on the range right here. And then the range is always going to be the same one. So when I copy my equation, I want that to be always the same. So how do we do that? Press F4 so you can log L7, and then divide that by 20. And it might put a bunch of decimals. Let's get rid of them. We don't need those. Let me zoom in here so you can see what I'm doing. So that's a formula. Now, so let's go to the formula. It is L35, which is this one, plus the range, which I log, and then divided by 20. Okay? Why didn't I log L35? Because I want to do the following. Copy that to the next one. And the next one, the next category is equal to what? The previous category plus the size of my category. And it's 20 of them, so we have to do this 20 times. And how do I know when I stop? If you look at the max is 42. So you have to go all the way to 42, which is this one. So copy until you get to 42%. Yeah. What do you mean?
In the equation,
Uh-huh.
the first equation is considered the number of.
Yeah, the minimum. Yeah. And then the next one will be previous one plus the range divided by the number of categories. And you have to extend this until you find your max. Okay? Now in Excel, those are called bin categories. So think about bins, where you put stuff. Okay? I may repeat the histogram next class. So we only have a few minutes, so let me do it for you. You do the following. You go to data, and then you click on data analysis. And then what am I doing? I'm doing the histogram. So you click in that option, and you click OK. And then what is Excel asking for? Input range and your bin range. Which one is the input range? It will be your daily returns. All of that right there. And the bin range, it is the ones we just created. So I'm going to highlight it. I know I'm going fast. You can watch the video later. I'll repeat it next class. And then you have to select this right here, chart output. Click OK. And there it is. That's your histogram. So is that normally distributed? Is that a normal distribution? No. So Netflix, stock, daily returns do not follow a normal distribution. Okay. Now, is it symmetrical? Do you have more or less the same on the right and on the left? Pretty much. And what was the skewness equal to? 0.95. What is the skewness for a normal distribution? 0. So this one is slightly skew, but it is fairly symmetrical. How about kurtosis? What is kurtosis for a normal distribution? 3. This one is 22, which means what? It has that big peak in the middle. So when you see the graph, that's what you see right there. You see that big spike in the middle. All of the data points, most of them are going to be lumped together very close to the mean. But you do have extremes on the right, and you do have extremes on the left. Okay. Let's see.